Hello, my name is Daniel Lambert. I would like to give you a little insight into our webinars. There's going to be 2 webinars in November for the CFA Level 1 exam. That's 1 week. It's Level 1 webinar held in German für unsere deutschen Freunde, and 1 different webinar from this held in English. So I would like to talk about in this webinar, in this free webinar, I would like to talk about something very important when it comes to your CFA Level 1 exam, and that is economics, and that is free trade and restrictions to free trade. So there are several restrictions like tariffs, there's tariffs, there are subsidies, there are import quotas, and so on and so on. We'll be looking at the welfare effects when it comes to those trade restrictions. Now, taking a look at the mind map, first of all, there is international trade and capital flows. I try to put all things together that are important, that you should understand, not only understand, that you should learn by heart when it comes or thinking about the CFA Level 1 exam. And of course, the same for CFA Level 2, I've got a mind map here as part of my online shop. I would just like to know everything should be working all right here with this webinar thing. Okay, now there's the international trade and capital flows. First of all, you need to understand goods and services, of course, the prices, the order key price, the world price, determined by free trade, then trade and free trade, the prerequisites of free trade, the advantages of free trade, and the disadvantages, so-called disadvantages to free trade, but we will see. You will see in the CFA curriculum that the advantages to free trade by far outreach the disadvantages. So it's very important to see that the advantages of free trade are much larger than the disadvantages. So, and then next thing to see, next thing to review, next thing to learn is there are absolute advantages that lead to free trade, and there are comparative advantages that also lead to free trade. Like Smith said, Adam Smith said that absolute advantages lead to free trade, but Ricardo said, no, it's not. Not only absolute advantages will lead to free trade, but also already comparative advantages do the same thing. But we'll be talking about this in a different video. We'll be talking about this in different contexts. So here, we will just move on to the next step. We will just move on to this, and that is trade and capital flows. Trade and capital flows, tariffs, quotas, export subsidies, and then, as a matter of fact, at the very end of this webinar, we'll be dealing with trading blocks. So tariffs, that's important. First of all, there are the effects of a tariff given the case of a small country, and that it's a little different because given a large country, there's some differences regarding these effects of a tariff. Let's take a look here. Take a look here. We have to see this. We have to see this. There's the x-axis, there's the y-axis. There is the quantity demanded and the quantity supplied on this horizontal axis. And there's the price on the vertical axis. Now, if we don't take a look at the country we're living in, or a different country we're not living in, we need to review the world market. So there's domestic demand, as well as domestic supply on the world market. Domestic demand, domestic supply. So, I mean, it's quite natural, like the slope it's an upward sloping curve. The supply curve is always, is nearly always, better put it this way, is an upward sloping curve, whereas the demand curve is a downward sloping curve, as is true here again. P star shall indicate the price when it comes to free trade. If there is free trade, if and when there is free trade, P star is going to be the world market price. So this is the case here. We have this line given the price of free trade, or if free trade occurs, this is going to be the price, leading to Q4, leading to here, how shall I call it, Q1, and that is that. So now, let's take a look at a small country. Let's take a look at a small country, and the small country imposes a tariff. As a matter of fact, this will lead to a rise in the price in the extent that the percentage of tax, because it is a tax, a tariff is a tax, right? So if I sometimes say not only tariff but tax, it doesn't mean that it's not a tariff, but we're talking about a tariff that of course will lead to a rising government revenue. So this is the amount of tariff. This is the amount of tariff that will lead to a rising price. And sure, it's gonna lead to a shrink. The quantity traded here is going to sink. This is Q2, this is Q3. So the quantity traded is only going to be Q2 to Q3 because the price is going to rise, as we can see here. So now we need to take a look at the welfare effects, because when dealing with tariffs, when dealing with quotas, etc., we want to take a look at welfare effects, consumer surplus as well as producer surplus, and of course also government's revenue. So consumer surplus is if you are willing to pay a certain amount of money for a given good, for a given quantity of a good, and you don't have to pay this much, but you have the right, or it's possible to pay less than this, then it's a certain consumer surplus because you were willing to pay more, but you didn't have to pay more. So first, what's the consumer surplus in the situation of P star? We might call this PT, the price after the tariff, and P star, surely the price before the tariff took place. The tariff was enacted. So consumer surplus, of course, is from here, from this point, let's call this point A, down to the point B, and of course to the point P star. Now, consumer surplus is the triangle from A to B to P star. That's consumer surplus because we go down to the very price and then go left. Now, because the price rises, consumer surplus goes down, of course, because we have to pay more, and therefore the people having been able and willing to pay more than they really had to do is going to go down as well. And if we call this A and B and C and D, and I might better call this point in a different way, and this as well. We better call it, shall we call it E? I think we should. And this point is going to be called F now. So actually, it is this. Actually, it is this area A. It is shaded in yellow. It is this area B, shaded in green. It is one area that is C, shaded in turquoise, blue, and the one that is shaded in pink now, called D. Those are the areas that add to the less, to the minus in consumer surplus. Consumer surplus is going to go down, unfortunately, because it's going to be a big part of national welfare. So A plus B plus C plus D is the loss in consumer surplus. That's one thing that you need to see for your CFA Level 1 exam. Consumer surplus is going to go down by A, B, C, D. Now, producer surplus. Producer surplus is going to go up because producers can sell their goods, can sell their services at a higher price, and therefore they're going to see a rise in the producer surplus. And this rise is going to be A. The rise in the producer surplus can be seen at the left side, at the left-hand side of the supply curve, and therefore it is A. So as we can see, A, B, C, D going down and A going up. The area of A is not really an important thing any longer because it's going to go up and down at the same time. So we can just say that A is not important at all. Now, taking a look at the remainder, which is B plus C plus D, how about this? How about B plus C plus D? That's, of course, right now, it's the loss in national welfare. If there wasn't, but there is, a rise in government's revenue. Government and domestic government revenue, of course, is the tax revenue. It's the tax revenue that is given by the quantity traded, which is Q2 to Q3 times the number times the percentage. So the percentage in tariff, which is this. This is the percentage in tariff multiplied by the quantity traded, Q2 going to Q3, is the government's revenue equaling C. So C is a positive thing, as well as A is a positive thing. On the other hand, A was a negative thing because consumer surplus, went down. So all in all, we have as the effect of tariff is going to be national welfare. National welfare is going down by B and by D, which is the green, the area shaded in green, and plus the area shaded in pink. So the green and the pink area is the national catastrophe. It's the national disaster because it's the thing that remains as a loss. The national loss, the national welfare loss, consists of B plus D. Given a small country and given a situation in which the small country enacts a tariff. So that's the tariff situation. The tariff situation will result in, given a small country, will result in a national loss of B plus D, which is different which could be different. It doesn't have to be different. It could be different in a large country. In a large country, the shaded areas, the green and the pink areas, B and D, could be smaller than the area C, but very important, the area C will not go up to the same level as B plus D, but it will go higher. It will be higher because a large country has different possibilities. So please remember, the effect is always negative given a small country. It could be positive in a large country. It doesn't have to be positive in a large country, but it could be possible that it's positive. The national welfare effect of the tariff could be positive in a small country, given the case. I'm sorry, again, the last sentence. The national welfare effect of a tariff could be positive, given the case of a large country. That was it. That was it. So, great. Talking about a tariff that was necessary. Now we're talking about a quota. A quota is a different thing. A quota is a different thing. So, what did I want to say? With a quota, we need to look at a different situation because the quota itself is different. I'll be back in a second. There I am. Because in a quota, the situation is different. A tariff would see that the quantity imported is multiplied by a tariff, by a percentage of tariff, and leads to a revenue for the domestic government. Now a quota is imposed by the importing country, and there's going to be a different effect, and which is important to see that if we construct a quota that's equivalent to the tariff, we can see this. Let's have a quota that is tariff equivalent. Quota equivalent to tariff. Equivalent to tariff. That's important because we could just as well construct other quotas that are not tariff equivalent, but then a comparison would be just impossible. So it's very important that we construct a certain quota that is absolutely equivalent to the one we constructed before, to the one we constructed when watching the tariff. Now, domestic supply, domestic demand, world market, all in all, the quantity demanded, the quantity supplied, and the price. Again, P star, the price at which we had free trade. Here, that is that. And now, that was Q1. Yes, that was Q1. So the quantity supplied at the world trade price, at the free trade price. Q4, the quantity demanded at the free trade price. And then we had the, if I can put it this way, we had the price that was a consequence of the tariff. And now we want to construct the quota just equivalent to that very situation, which means we would impose a quota. From here, from this situation Q2 to this situation Q3, meaning that the quota itself is this amount of trade, is this amount of quantity. That's the quota. And as you can see, that quota is totally tariff consistent, tariff equivalent, because it leads to the same situation, Q2 and Q3, that could only occur given the price situation after the tariff. That's why. So now we have a situation with which we can just as well and very easily compare the tariff situation on the one hand, as well as the quota situation on the other hand. And now, we still have, I want to have the same colors, B and D. B was this and D was that. Dum, 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 dum. And green, that was the green area shaded in green. That was B, that was D. And they were the losses, the national welfare was a loss. It was a national disaster, as I would call it, given the tariff situation. Now, the situation, the national welfare situation, given the quota, is a bit different. It's a bit different because the welfare loss of a tariff is B and D. The welfare loss of a tariff, if I can put it this way, was B plus D. But here, given a quota, national welfare loss is different. It's still a loss given a small country. Quota, import quota. And it's no more B plus D, but it's BCD. It is BCD if the quota cannot be auctioned. If the quota cannot be auctioned by the domestic government. If it can be auctioned, if it was possible to auction the quota, here it would be a bit different. It would be the case that the area C would, in total or in part, be auctioned and would lead to a government's, to a domestic government's revenue. So this in fact means that the welfare loss of a tariff is B plus D, but the welfare loss of a quota is at most B plus C plus D, but it could be less. It could also be less because part of area C could be auctioned and therefore could lead to the opposite, could lead to a revenue of domestic government. That's it. So BCD at most. At most it is BCD. Maybe it's smaller. Maybe it's smaller. That's important to see when it comes to the import quota. Then we still have another thing to discuss, not quotas, but the voluntary export restraint, which of course is a special type of quota. But yeah, quota consists of import quotas and the voluntary export restraint. The voluntary export restraint is a quota imposed by the exporter, at least officially. At least officially. That's the version that the books like to maintain. But reality is different. Reality is different because the exporter doesn't voluntarily decide to impose a quota. Sometimes, and in most cases, he or she or the exporting country has to say so, has to do so. And that's why I wouldn't say it is really a voluntary trade restraint. It's more or less not voluntary, but that's between the lines. That's not part of the thing you need to know when it comes to your exam. So the quota rent, the area C, is captured by the exporting country, which means the welfare loss, of course, and always is B plus C plus D. That's what I wanted to say. That's BCD, the welfare loss with a voluntary export restraint, VER, or trade restraint, voluntary trade restraint, is always B plus C plus D because the trade area or the area C is always outgoing to another country, to the exporting country. So the welfare loss of the importing country is always B plus C plus D. That was this. And now the welfare loss, given the tariff only, was B plus C, as we could see. And that was smaller of B, C, and parts of D. Parts of D. I would say a part of D is lost in the case of an import quota. So smaller or equal to, smaller or equal to the welfare loss of an import quota, because I wouldn't be like, it wouldn't be good to write quota, because the voluntary export restraint is a quota as well, as I indicated in the mind map. That's it. And those are the losses of national welfare when it comes to national welfare. So not only a loss for consumers, not only a gain for producers, not only a possible gain for the domestic government, but all in all, national welfare loss. Given a small country, right? Given a small country. Because in a large country, this could be different. Small country only, not a large country. That was it. That was that. So when we go back, we talked about tariffs. We were talking about quotas, which means import quotas and voluntary export restraints. We did not, so far, we did not talk about export subsidies. An export subsidy is a little different because it's still a restraint on free trade. An export subsidy puts an advantage to the home industry, and therefore is a restraint to free trade. Maybe not that clear from the beginning, but as we can see closer, as we look at this closer and closer, we see that export subsidy is, of course, a restraint to free trade. But of course, it's not true that that it leads to revenue for domestic government, but just the contrary. Domestic government pays something out. There's an outflow of money, an outflow of cash outflow. So export subsidy does not lead to domestic revenue rising. That was this. What did I want to say? I wanted to go here to those questions. Let's see this. Maybe this question could be your question. Maybe those questions could be yours in your CFA level 1 exam. I don't know. You don't know for sure so far, but you'll see. So now, question 1 is going to be, we'll be talking about this later on. How about late question 2? Yes. Oh yeah, question 3. Question 3, I think, is best now, because we were just talking about the implications and the order of national welfare loss. Because the order of national welfare loss, if I can show you again, is this. The loss is smallest given the case of us looking at welfare at a tariff only. Given the case of a small country, it's larger or as large with an import quota, and again larger with the voluntary trade restriction, the voluntary trade, as I call it, voluntary trade restraint. That's it. And so you'd be able to answer this question. Now, given the case of a small country, question number 3, given the case of a small country, not a large one, which of the following trade restrictions probably has the smallest welfare loss for the important country? Please be aware of this. CFA Institute could pose questions that say, which is this or that, and of course, which is not, like, which of the following answers is most likely to be this and that, or which of the following answers is least likely to be this and that. So you really need to pay attention to the question, how the question is put forward, Is there a not? Is there a word not? Or is there not a word not? If you see what I mean. Okay, now, which has the smallest effect, the welfare, for which of the following restraints to free trade is the welfare effect smallest for the imported country, given an import quota or given a tariff or given a voluntary export restraint? And the answer, of course, is, as you can see here, the tariff. The tariff situation leads to the smallest national welfare loss. So A is correct. Number A, the import quota, is correct. So this is the correct answer for question number 3, isn't it? That was this. Question number 2, which type of trade restriction would most likely, not least likely, but most likely lead to an increase in the domestic government's revenue? We said that export subsidies, an export subsidy is not a rise, does not give rise to the rise, it does not give rise to rise, but it's going to shrink domestic government's money. So I just want to say B is totally wrong. B is totally wrong because an export subsidy is by no matter a cause of rising domestic government's revenue. It's going to shrink. That's why B is wrong. What was the question? It would most likely lead to an increase in the domestic government's revenue, not with an export subsidy, not with a tariff. I'm sorry, with a tariff, yes, because a tariff will lead to a rising government's revenue given by T multiplied by Q3 minus Q2. As I said, the area C. So the area C, I called it the area C here in this picture when reviewing the effects of tariffs. So this is C, and which means that answer C is true. Answer C is true. T2 is C. That was it. Increase. And the question is which of those is always true? Because number A, import quota, could be true. Number A could be true if national government was able to auction the entire amount, the entire area. But, as I said, would most likely lead to an increase. This means that C, number C, answer C is always true. Answer A could be true, which means if I use the word now, C is true, then A, right? If I have the right to use this word in a wrong connotation. Because like C is always true, A could be true, therefore A is wrong and C is true, if you know what I mean. That was it. That was concerning number 2. That was talking about trade restrictions. Now, I wanted to talk not only about trade restrictions, but of course also about trading blocks. I wanted to put your attention, to get your attention when talking about trading blocks. There's the free trade area, which is the smallest type of trading block, the weakest type of trading block, the free trade area. There's the customs union, there's the common market, there's the economic union, and the monetary union. So now, the smallest one, the weakest one, is the free trade area, in which the member countries decide to have free trade. Then there is the customs union. In the customs union, it is true that the tariff between countries A and B, member countries A and B, is restricted to 0. There is no tariff anymore. But there is a one and only one tariff against the rest of the world. So which means this. If I can just put it this way, we have country A, we have country B, A, B, and we have the rest of the world, C. C will be the rest of the world, so A, B, C is the entire world. So now, if there is country A and B, and if countries A and B decide on having a customs union, they change the following. They change this. Whoa. They will not have a tariff. The tariff is going to go down to 0%, which means all tariffs between member countries A and B go down to 0. There is no tariff any longer, but the same tariff remains with A and B when it comes to the rest of the world. So the rest of the world and the customs union A and B have the same, have one and only one tariff. So if there were different tariffs of A against C and of B against C before entering the customs union, now there is only one tariff with A and B against the rest of the world. That's it. That's the meaning of a customs union. And then the difference between a customs union and a common market, because here I'm taking a look again at the mind map, there has to be a difference between customs union on the one hand and common market on the other hand. The difference is this: with a common market, there's free movement. There's free movements of factors, of production between among those member countries. So a customs union does not apply, does not allow free movement of factors like capital, like labor, but a common market does allow free movement of factors, whereas a customs union does not. So that's the difference you need to see between customs unions and common markets. Now the first and last question for today. Next week, we're going to have a free webinar concerning financial reporting and analysis, but I'm going to talk about it later in 5 minutes. Country A. Country A has a tariff of 20% on all goods, and B also has a tariff. So if A and B both agree not to have tariffs any longer, and if A and B enter into a customs union, but they maintain a tariff of 20% against C, this is most likely not. Have you read the word not? You haven't. You haven't. Now you have. There is a not. There is a not being part of the answer. This is most likely not a customs union, common market, or free trade area. Actually, it is a free trade area, and actually it is a customs union, but it is not a common market, because it's not a common market because I did not talk about free trade, free movement of labor, and I did not talk about free movement of capital. So that would be included in a common market. This is not included in a customs union. Talking about customs unions, we only put our eyes to the tariffs and then the existence and non-existence of tariffs. But with common markets is different. Then we'll see that there's free movement of labor and capital and of factors in general. So here, answer B would be correct, because it is not a common market. It is a customs union. It is a free trade area, because a customs union is more than a free trade area. So answer B would be correct for question number 1. That was it. That was it for now. That was it for today. Talking about what I wanted to talk about, economics. We'll have more webinars. We'll have more free webinars. Next week, we're going to have a free webinar, financial reporting and analysis. We'll be dealing with the cash flow statement. And on Friday next week, we'll be talking about equity, another free webinar, equity. We'll
deal with indexes, the choice of indexes, and how to weigh them, etc., etc. And then, in, I guess, 10 days, 9 days from now, it's a free webinar dealing with derivatives. Binomial tree, for example, we'll be dealing with calls and puts, how to long calls, how to short calls, how to long puts and how to short puts, and then the binomial tree, arbitrage gains, etc., etc. Wonderful subject, really wonderful. So please join in for those free webinars. And of course, there's two non-free webinars in November 2018, one in German and one in English. And however, whatever language you speak, whatever language we prefer, German or English, there's going to be a Lambert webinar in November 2018. I would like to thank you for joining. Thank you for watching. Thank you for listening. Also, I'm going to put this video on YouTube so that you can watch it later on. And yes, thanks for watching. Thanks for listening. I'm Daniel Lambert, Germany.